This is Satya Pradhuman of Cirrus Research. I want to call your attention to the latest asset allocation report called Signals. The title of this report is Small Cap Growth to Lead Large Cap Growth, as mega cap innovation appears, the break in it appears to be latent. This chart, I think, does a really neat job of representing the two worlds we're talking about here. The thin purple line at the top represents the breakage that we've been witnessing in smaller, riskier innovation stocks. In this case, we're using one of the ARK funds as a proxy. The thicker blue line above represents an expanded FANG. And what we're getting at here is that these bins should be quite correlated. And in fact, I think what's going on is that the initial wave of interest rate risks have really hit the more speculative small cap names. What we're beginning to witness is now a sort of contagion that's spreading to the larger, more liquid shares. And we think unless we were to really shift away from this concern on inflation, higher commodity prices, all the surprises coming out of China, not to mention the commodity spikes that we've seen. Unless those begin to fade, we believe what we'll likely see is this sort of breakage that you're witnessing in some of the sacred cows of technology will likely continue. The second chart here represents our style indicator between growth and value. When the line is above usual, it's a severe overweight in growth stocks. When it's below normal, it's a severe overweight in value shares. And what we're saying is that there's a lean growth reading right now. And I think to some degree, this reading is correct, that what we expect is a much more benign performance gap or spread between growth and value pretty much for the remainder of the year. Part of this has to do with what we just spoke about, which is the break in large mega cap growth stocks. The innovation names will continue to come down. We think there's still more pressure there. At the same time, it'll be offset by high quality visible earnings, a very different piece of the growth puzzle. Counter to this is the idea that if commodity prices are higher for longer, you're likely to see pockets of the value benchmark actually post quite good returns. And after all, valuations matter if rate risks return. Thank you.